The IRS has a deadline that could cost you thousands of dollars, and almost nobody knows about it. If you have money sitting in certain retirement accounts and you turn 73 this year, the government requires you to take money out, whether you need it or not. Miss this deadline, and the penalty is steep. Stay with me because by the end of this video, you will know exactly which accounts to watch, exactly when to act, and exactly how to avoid losing your hard-earned savings to unnecessary taxes and penalties. For decades, you worked hard and saved carefully. You put money into accounts like traditional IRAs and 401k plans. The government gave you a tax break when you put that money in. But that break came with a catch. Eventually, the government wants its share. That moment arrives through something called a required minimum distribution, or RMD for short. An RMD is simply the smallest amount of money you must take out of certain retirement accounts each year starting at a certain age. Right now, that age is 73. This changed recently. It used to be 70 and a half, then it moved to 72, and now it sits at 73 for most people. Starting in 2033, it will move again to 75. These changes came from a law called the Secure 2.0 Act, passed by Congress. The goal was to give people more time before forced withdrawals begin. But here's the problem. Many seniors do not realize the rules changed, and they either take money out too early, missing years of tax-deferred growth, or they miss their first deadline entirely and face a painful penalty. Here is why this matters so much. If you do not take your RMD on time, the IRS can charge a penalty of 25% of the amount you should have withdrawn. That penalty can drop to 10% if you fix the mistake quickly, within what the IRS calls the correction window. But even 10% of a large account balance can mean thousands of dollars gone, for no reason except a missed paperwork deadline. Before we go further, if this kind of information feels useful to you, please consider subscribing to this channel and tapping the notification bell. We cover deadlines and rule changes like this regularly, and these dates can sneak up on people. A notification might be the only reminder you get before a costly mistake happens. Now let's talk about which accounts actually fall under these RMD rules, because not every account works the same way, and the differences matter. The first account is the traditional IRA. This is one of the most common retirement accounts in America. Money goes in before taxes are taken out, grows over the years, and is taxed only when you withdraw it. Once you turn 73, the IRS requires you to start withdrawing a minimum amount every year. The amount is based on your account balance at the end of the previous year divided by a life expectancy number from an IRS table. For example, if your IRA had $200,000 at the end of last year, and the IRS divisor for your age is about 26.5, your required withdrawal would be roughly $7,547 for the year. That amount counts as taxable income, added to whatever else you earn that year. The second account type is the traditional 401k from a former employer. If you have an old 401k sitting with a company you no longer work for, the same RMD rules apply starting at age 73. Many people forget about old 401k accounts from jobs they left years or even decades ago. The IRS does not forget. If that account exists and you are over 73, a distribution is required even if you have not touched that account in 20 years. Here is something important to know. If you are still working past age 73 and you do not own more than 5% of the company you work for, your current employer's 401k might be exempt from RMDs until you actually retire. This is sometimes called the still working exception. But this exception applies only to your current employer's plan, not to old 401ks or IRAs. The third account is the SEP IRA, often used by self-employed people or small business owners. A SEP IRA, which stands for Simplified Employee Pension, follows the same RMD rules as a traditional IRA. If you ran a small business years ago and set up a SEP IRA, that account is subject to the same age 73 deadline, calculated the same way. The fourth account is the Simple IRA. This stands for Savings Incentive Match Plan for Employees. It is another retirement account often used by small businesses. Just like the SEPIRA, the simple IRA follows traditional IRA rules for required withdrawals starting at 73. If this is helpful so far, please give this video a like. It helps more people see this information. And if you have questions about your own accounts, leave a comment below. Many people watching have similar questions, and we read every comment. The fifth account, and this one surprises a lot of people, is the inherited IRA. If you inherited an IRA from a parent, spouse, or other relative, special rules apply, and they can be confusing. If you inherited the IRA from your spouse, you generally have the option to treat it as your own IRA, which means the standard age 73 rules apply to you personally. But if you inherited an IRA from someone who was not your spouse, like a parent or sibling, different rules kick in. Under the Secure Act, passed in 2019, most non-spouse beneficiaries must empty the inherited account within 10 years of the original owner's death. In some cases, the IRS also requires annual withdrawals during those 10 years, depending on whether the original owner had already started taking RMDs. This area trips up a lot of families because the rules depend on exactly when the person passed away and what type of account it was. Now let's talk about a real example using a fictional person we will call Margaret. Margaret is 73 years old. She has a traditional IRA worth $150,000 and an old 401k from a job she left 15 years ago worth $80,000. Margaret did not realize both accounts required separate RMD calculations. She calculated only her IRA's required withdrawal, took that amount, and assumed she was done. But the old 401k also required its own RMD. Because she missed it, Margaret faced a penalty on the 401k's required amount. Once she realized the mistake, she contacted the plan administrator, took the missed distribution quickly, and filed the proper form with the IRS to request a penalty waiver. The IRS does allow penalty relief in some cases, if you can show the mistake was due to reasonable error and you are taking steps to correct it. This brings us to an important point. If you miss an RMD, do not panic, but do act quickly. The form you need is IRS Form 5329. On this form, there is a section where you can request a waiver of the penalty by explaining what happened and showing you have now taken the missed distribution. The IRS reviews these requests, and many people do receive relief, especially for first-time, honest mistakes. If you have a parent or grandparent approaching 73, or if you know someone managing multiple retirement accounts from old jobs, please share this video with them. Many people have several scattered accounts from years of changing jobs, and tracking every RMD deadline across all of them is easy to overlook. Let's go over how to actually calculate your RMD step by step, because this is something you can do yourself with just a little information. First, find your account balance as of December 31st of last year. This number comes from your year-end statement, which your financial institution sends automatically, usually in January. Second, find your age this year, the year you are taking the distribution. Third, look up the IRS Uniform Lifetime Table found in IRS Publication 590-B. This table gives you a divisor number based on your age. For example, at age 73, the divisor is approximately 26.5. At age 75, it drops to about 24.6. At age 80, it is around 20.2. Fourth, divide your account balance by the divisor number for your age. That result is your required minimum distribution for the year. For example, if you are 75 years old and your IRA balance at the end of last year was $300,000, you would divide $300,000 by 24.6. That gives you approximately $12,195. This is the minimum amount you must withdraw this year from that account. One more important detail. If you have multiple traditional IRAs, you can calculate the RMD for each one separately, then add them together, and withdraw that total amount from just one of the IRAs, or split it however you like. However, 401k accounts work differently. Each 401k's RMD must generally be taken from that specific 401k account. You cannot combine 401k RMDs the way you can combine IRA RMDs. Now, if this information feels overwhelming, that is completely normal. These rules were not designed with simplicity in mind. But remember, you do not have to memorize everything. You just need to know that these accounts exist, that a deadline applies, and that help is available if you need it. Speaking of help, if you have not subscribed yet, now is a great time. We cover topics like Social Security timing, Medicare enrollment deadlines, and tax saving strategies for seniors. These topics connect to each other more than you might think. For example, your RMD income can affect whether your Social Security benefits get taxed, and it can affect your Medicare premiums through something called IRMAA, which stands for Income Related Monthly Adjustment Amount. A subscription means you will not miss these connections when we cover them. Let's talk about IRMAA for a moment, because it surprises many seniors. IRMAA can increase your Medicare Part B and Part D premiums if your income is above certain thresholds. For 2026, if your modified adjusted gross income from 2 years ago was above approximately $106,000 for an individual, or approximately $212,000 for a married couple filing jointly, your Medicare premiums could be higher than the standard amount. Since RMDs count as income, a large RMD could push you into a higher IRMAA bracket, increasing your Medicare cost the following year. This is why some financial professionals recommend planning RMD withdrawals carefully, sometimes years in advance, rather than waiting until the deadline. One strategy some people use after consulting with a tax professional is called a qualified charitable distribution, or QCD. If you are 70 and a half or older, you can transfer money directly from your IRA to a qualified charity, up to $105,000 per year as of 2026. This amount counts toward your RMD, but it does not count as taxable income. For someone who already gives to charity and does not need all of their RMD for living expenses, this can reduce their taxable income while still meeting their RMD requirement. Let's go over some common mistakes and questions people have about RMDs. One common mistake is forgetting about old accounts. People often have retirement accounts from jobs held decades ago. If you are unsure what accounts you have, you can request a search through the Department of Labor's abandoned plan database or contact former employers directly. Another common question is what happens the very first year you turn 73? The IRS gives you a small grace period. You can delay your first RMD until April 1st of the following year. However, if you do this, you will need to take 2 RMDs in that following year, which could push you into a higher tax bracket. Most financial professionals suggest taking your first RMD in the year you turn 73, rather than delaying to avoid doubling up. Another question people ask is whether Roth IRAs have RMDs. As of 2024, thanks to Secure 2.0, Roth 401k accounts no longer require RMDs during the original owner's lifetime, matching the rules that have always applied to Roth IRAs. This is a helpful change for people who have Roth accounts, as it gives more flexibility in retirement planning. If you have made it this far, thank you for sticking with us. This is detailed information, but it is information that protects your money. If you found this helpful, we would love to hear from you in the comments. Tell us which account surprised you the most, or whether you discovered you have an old account you forgot about. Your comments help us know what to cover next, and they help other viewers feel less alone in figuring this out. Let's wrap up with the most important points to remember. Required minimum distributions begin at age 73 for most people, and will move to 75 starting in 2033. The accounts affected include traditional IRAs, old 401k accounts from previous employers, SEP IRAs, simple IRAs, and inherited IRAs, each with their own specific rules. Missing an RMD can result in a 25% penalty, reduced to 10% if corrected quickly, but the IRS does offer relief for honest mistakes through Form 5329. You can calculate your RMD using your account balance and the IRS Uniform Lifetime Table found in Publication 5.9. O-B strategies like qualified charitable distributions can help manage the tax impact of RMDs, especially for people who give to charity. And RMD income can affect both Social Security taxation and Medicare premiums through IRMAA, so planning ahead matters. The most important thing you can do today is simple. Make a list of every retirement account you own, including old accounts from past jobs. Check your age this year. And if you are 73 or older, confirm whether you have taken your RMD for this year from each applicable account. If you are unsure about any of this, a tax professional or your account's financial institution can help you with the specific numbers for your situation. Thank you so much for watching this video all the way through. We know this is a lot of information, and we appreciate you taking the time to protect your financial future. If this video helped you, please consider subscribing, giving it a thumbs up, and sharing it with someone who might need this information. We will see you in the next video, where we will continue helping you make sense of retirement rules, one step at a time.